He walked away with over $400 million. His employees witnessed their hopes for stock wealth vanish, and the investors who believed they were financing the future of work ultimately found they were primarily supporting a corporate cult centered around one individual, Adam Neumann. This story goes beyond just desks and free beer. It illustrates how Wall Street can be captivated by confidence, how governance is often seen as a tedious detail, and how a founder can transform hype into substantial financial gain while leaving others to bear the risks. Let's have a quick reality check. WeWork wasn't a complete fraud. The buildings were real, the members were real, and the demand was genuine. However, the valuation and the founder's behavior were where the deception lay. It wasn't a street con, it was a boardroom con. The perfect pitch: real estate, but make it tech. WeWork's magic trick originated from a simple idea that sounds brilliant in one sentence. Lease office buildings long-term, redesign them attractively, and rent them out short-term to startups and companies seeking flexibility. That is a viable business model, but the problem arises next. Neumann and WeWork did not present themselves as a real estate company subject to real estate risks. Instead, they portrayed themselves as a technology company with tech-like growth and tech-like valuations. This approach enabled them to persuade investors to pay exorbitant prices for a business that fundamentally relies on long leases, costly build-outs, and high occupancy rates. Wall Street loves tech because technology scales, but office space doesn't scale like an app. So, WeWork required a secondary product, not a service, a story. The cult aspect. When a CEO becomes the brand. Most CEOs aim to build trust in their company, but Neumann focused on making people believe in him. This is where the narrative takes on a true crime tone. Cult leadership often follows a familiar pattern: a charismatic leader, a grand mission, an inner circle, and a consistent message that anyone questioning the plan doesn't understand. WeWork's brand was never simply "we rent desks." It was "we are changing how humans live and work." This messaging wasn't a minor detail, it was central to how the company raised funds and justified its losses. If you're wondering why investors tolerated the chaos surrounding WeWork, it's because the company's top-line numbers resembled a rocket ship. This kind of growth can distract people from potential dangers, much like loud music can drown out a fire alarm. The first warning signs: governance that seemed almost comical. When WeWork filed for its IPO in 2019, the public got a glimpse inside, and the details were shocking. Reports revealed issues including Adam Neumann's special voting control, family involvement, and a complex network of related party transactions and loans. Typically, serious investors would retreat at this point. However, in WeWork's case, many didn't, at least initially, because the hype was still convincing. Then the public posed a brutally honest question: if this business is so great, why does it burn through so much cash? The IPO process not only slowed WeWork down, but also exposed the disparity between the narrative and the reality, leading to the unraveling of the con. The villainous move: cashing out before the crash. This is where the story takes a darker turn. Multiple reports indicated that Adam Neumann had already cashed out hundreds of millions of dollars before the IPO even occurred. PitchBook reported that he had liquidated over $700 million since 2014 through share sales and by borrowing against his stake. Consider the imbalance in this situation. Employees were encouraged to believe, and investors were urged to trust the vision. Yet, the founder was already transforming the hype into personal wealth. This is a classic sign of a dangerous founder-driven bubble, when the leader is cashing out while everyone else is still living in PowerPoint presentations. The fall, IPO disaster, and the SoftBank rescue. In 2019, WeWork's IPO plan collapsed. The valuation, which had once hovered around $47 billion, shifted from a celebration to a delusion. When WeWork couldn't secure public funding, it desperately needed a lifeline. That lifeline came from SoftBank, which had already invested billions into the company. SoftBank intervened, Neumann exited, and WeWork's narrative of being the future of work was replaced by a much simpler headline: "This company might not survive." Now, here's the part that infuriates many people. The exit package: lose the company, win the cash. In 2021, multiple reports revealed that Neumann received a substantial payout as part of a renegotiated exit arrangement, reportedly $245 million in stock plus $200 million in cash, totaling about $445 million. This is why the phrase, "he walked away with $400 million," isn't just a random figure. The actual reported exit package was even higher. Depending on which report you refer to, there were also additional components related to fees, non-compete agreements, and stock sales to SoftBank that further increased the total benefit. So, while employees and smaller shareholders watched their dreams collapse, the founder, who was the face of that dream, had already secured a golden parachute. That situation isn't merely bad optics. It represents a structural injustice inherent in the way hype-driven markets operate. Why employees walked away with nothing. Many employees joined WeWork during its high valuation period, receiving part of their compensation in the form of stock options. When a company appears unstoppable, stock options can feel like a second salary. However, stock options only hold value if the company successfully goes public or is sold at a high price. WeWork's IPO collapsed, then the valuation fell, then it eventually became a public company through a SPAC process at a far lower valuation than the peak. And later, the company filed for bankruptcy, in which existing equity is often wiped out. In May 2024, WeWork's Chapter 11 plan was approved, allowing it to eliminate about $4 billion in debt and transfer ownership to lenders, leaving the company valued at roughly $750 million, a stark decline from its previous $47 billion valuation. The real issue wasn't fake offices, but rather the mismatch between WeWork's risk profile and its actual business model, in which short-term revenue hinged on long-term costs. This disparity led to reckless expansion and a culture of hype that perpetuated a bubble, driven by founders' pressures and investors' narratives. Intelligent investors can fall prey to psychological manipulation following a cult-like formula of grand missions, loyalty rewards, and punishment for dissent. Wall Street's adoration for visionary founders creates vulnerabilities. Neumann benefited during WeWork's rise while employees and investors absorbed the fallout when the company collapsed. Even post-bankruptcy, Neumann sought to regain control, illustrating how founders can treat companies as personal fiefdoms. If you want the real value from this video, it's this checklist. If you see these signals in any hot company, be careful. A company calls itself tech, but its costs behave like a heavy old industry. The founder has unusual control and can't be challenged. The mission is emotional, but the unit economics are unclear. The founder is cashing out early while preaching sacrifice. The company grows faster than its systems can handle. And finally, the business needs constant fundraising just to breathe. Because when the music stops, the people who took cash earlier don't feel the fall the same way. Everyone else does. These indicators suggest that when the music stops, only certain players will be spared the consequences.